whatever. So I'll cover about these things in the future. But balance price range, you might see that is this one. The market went up and it went down immediately. Hence, it balanced. It did its buy side and its sell side, so it's balanced. You understand? Like from this price level to there till back there, this price level is what is balanced. You understand? So that's a balanced price range. The market, what is doing is balancing. Is balancing. Balancing is mitigating of orders. We are balancing and making the market efficient. That's what we are doing. I am the algorithm. This is the machine of all trades, master of none. I am the ghost in the machine, and the financial market is where I operate. That's where you want me. If you want me, I'm there. Here's an example with the Polish pound versus US dollar. Later I see it, the Nasdaq 100, Nasdaq US one, yeah, this one, whatever, is the British whatever. So what do you see? The market is in a bearish trend. As we can see, it has its buying, selling, buying, selling, buying, selling, buying, selling. Failure swing to break this whatever. So if there's a failure swing, why is it failing? Well, you have to wonder, why is it failing? Maybe it's failing to go up, or just make others think that this, this was a buy level support up, and then we go hit those people, take some liquidity and go up, or maybe just continue because after we have effed up those other traders. So yeah, so I told you guys about dealing ranges. So from here, what is the immediate dealing range that you can see that's clear, that's big? You can, what happened? I am the ghost in the machine. I was just, removing something in my eye. So that's how I operate. So I'm sorry for glitching. Whatever. So immediately I see this dealing range from this high to that low, the bearish dealing range. We broke the level here, hence making that dealing range. Hence that retracement to the upper side was to mitigate the premium levels at upper side of that dealing range, to go back to the discount levels and target whatever. And as you can see, we targeted this rejection block at the end, or maybe this rejection block. I'll show them. Let's continue. This is it. So you can label whatever. You can take a break, pause, label. You can continue the video later. Take a screenshot, label. Don't be immediately rushing. Don't be like that, my brother. I told you, even in bed, when you immediately rush, it's not going to be well. You're not going to do well in bed if you rush things. You won't sleep. You need, let sleep come back. Let sleep come to you. You understand? So yeah, you can see whatever. I'm not going to do that because I already labeled, because I'm the machine. Well, those are the labels. This is the rejection block. As I told you, it went up, made a high. So that high that was made, it was made by, it left a rejection block. So smart money did it. They did that heavy selling at those levels. Hence they have to mitigate their heavy buying from this level to that level that they did as a manipulation. uh, Accumulation, manipulation, delivery, distributing those distributing those orders, taking profit, mitigating their losses, the current losses, taking them as zero, where at profit, selling again. All because of the algorithm, not because of smart money. They're not there doing the pricing, the whatever. If we have technology, why would you do that? Nigga, smart money. Stop doing that. If you think you get, if people think they are smart money because they are people, they work at big banks, they are stupid. They have to tell me the drugs that they are smoking. I need to know them. I love them. They are smart money because they have cash, liquidity, but the algorithm doing the trading, doing the chat, whatever, doing the chatting is everything that is doing the chatting and the pricing is the algorithm by that is doing on behalf of the central bank, which are facilitating those transactions through the what? through the clearing houses like the the DTTC and CLS Group and the others like the Fedwire, the Big Mama of the whatever. Yeah, so this is the whatever rejection block. That's an example of the rejection block. This is an example of the I thought I had an example that was better, but anyway, I so this is the rejection block. This is an order block. As you can see, it was an up close candle before the down close started. So this is our order block, and again it is our bearish. This is our supply zone because it was unmitigated. So I'll teach more about supply zones in the future because supply zones are the first entry models that I'm going to teach about before we get into other entry models. And this is the bearish order block, this down close candle before the uptrend to break and manipulate into whatever. And this is its other one that did it again. So this is the other block, bearish breaker blocks. This one, this other one, and this one. Those are the ones. One and this other one. But this is the one that did the breaking. But because it's within this one, we might treat this as a propulsion block, even though it's not digging in, but it's in within the whatever, the bearish breaker. So since it's within the bearish breaker, it'll be a propulsion bearish breaker. You understand? If it did agree going there and going up, it will be a propulsion block. But since it didn't, I'm sorry. If this is the wrong way of treating propulsion, saying this is a propulsion block, I'm sorry. That's how I treat them. Still, it's a order block that turned into a bearish breaker block because price went very quick, took them out very quick, put them in a loss because they're the ones that did the heavy selling. They did the manipulation and didn't have time to take their losses there and then take their profits up there, and they did the heavy selling immediately. And once they did, they went to mitigate those orders at a zero, of which you traders want. You want to see your trades going up in profit. When they get into losses, you want to see them being mitigated and take you out at a zero, maybe at a profit. That's what smart money is doing for itself, not for you. So be smart money and think like them so that you can do it for yourself, but not really like them because they have money. You can't. Wanna just go where they want to go, the right side. So yeah, that's the bearish order block, bearish breaker block, whatever. That's the break of that bearish breaker block and that break of structure. It happened there, then it went down. It didn't when it wanted to go up, it didn't return at the 50%. So we want to do as a dealing range that was valid. So it went to extend that dealing range there. It extended it. So the dealing range is there. I'll teach you about dealing range in the future video, which is tomorrow or tomorrow of the tomorrow, next tomorrow, whatever. So yeah, so those are the targets that we want to see for our no those are the entry points for us. So the moment when it starts retracing, all of the signatures or all of the premium discount areas that it leaves, those are our targets at the downside. You understand? So this is the bearish breaker because it broke, went down, taking these levels, breaking these levels, and it was broken there, making it a breaker, bullish breaker. Well, you thought it was a bullish and bearish order block, it tend to be a this candle, this white one, this up candle is a break block, which is the bullish one. Bullish mitigation block. Mitigation blocks, they do not break, but they try to break and they fail. Because they are the ones that make failure swings. Because they will try to push the market down and it didn't break, hence that failure, it will treat this as a mitigation block. Why is it a mitigation block? Because we have no other way to call it than mitigation, because we just want to mitigate our orders because we didn't take any profit as smart money. So let's go back and return, which it did. Where you see this bearish mitigation block, I think bullish mitigation block, it was mitigated where here and more here, and yeah. So